goals will not be achieved. So with that, I start my presentation. Today, we are going to cover the topics on importance of financial planning. Then, different financial goals and, importance of, taking care of a few financial, investments which should be mandatorily there to us, and ways to achieve our financial goals, and do it yourself financial planning. So to start with, why we should have a financial planning, importance of financial planning, as I mentioned here. This is the first slide, no, which is representing the financial planning pyramid, wherein it shows that any investment, no, it will start with a basic no investment start from defensive planning, that is
Sir, you are muted. Please unmute it.
Asha ma'am.
Ma'am, can
Yes,
you
Asha
hear?
ma'am.
Yes, ma'am.
Somebody is muted. Sir's
He can
presentation.
unmute, ma'am. He can unmute.
Ma'am, can you hear?
Okay.
Is it okay?
Yes sir. Yes sir. Yes sir.
Okay, and I'm presenting the slide also. So if any issue, please you can let me know. So as I said, protection is the
Sir, we are not hearing your voice.
Ma'am, I have unmuted myself. Hello.
Sir, now we
Hello.
are hearing.
Yes sir. Carry on.
Audible, sir.
Don't interrupt the
Oh.
session. Please kindly give your cooperation at the end of the session, please.
Yeah. So now next is growth planning, or it is also known as savings investment savings planning. So we have various resources like deposits, corporate fixed deposits, bank deposits, postal savings, and endowment plans. These will take care of our saving needs. And next is those who have take care of the protection as well as the basic savings. They can look for investing and creating a wealth for themselves and their family members. That is in the third phase, that is aggressive planning. This is also known as investment planning pyramid stage, wherein you can invest into mutual funds, ULIPs, equities, PMS, and other financial products which are there for investing for a long term, and which can create a wealth to all of us. So this is how the financial planning pyramid is designed, so that the entire planning depends on how well, how better we are planned for our protection needs. Because as a earning person, if we are not alive, the entire goals of investments will go haywire. If we are alive but we are not able to earn because of ailment, or because of ill health, then that is also a devastation. So it is very important, any kind of financial planning, it should be ideally in this format. Okay, the next slide we will be going, which is elaborate version of the same thing, which the last financial planning pyramid itself, it is explained in a detailed way, wherein it shows the basic needs are the same thing, are represented in three ways. One is events out of our control, which we have to plan very much strongly and at the early stage of our earning phase. So events which are out of control, you can see here, becoming independent, becoming dependent is a big problem, maybe due to disablement or disease or any kind of accident or anything. Then suffering health issues, this is again a big issue. And then premature death, suffering with serious illnesses, becoming disabled. These are the couple of things which are not in our control. So we have to see that the stream of income which we are started off should continue in presence of us and in absence of us also to our family members. So this is very, very important. Next is the things which are in our control. That is like children education savings, for constructing a home, for retirement savings, and have a emergency cash, personal savings, debt reduction. These are in control and which also need a proper planning for. Once these two things are done, then we can look for estate preservation. That is, whatever the properties we buy, the wealth we have created, how to create, save that, and then increasing the wealth, how to increase our wealth, create a legacy to our family members, and leave something after our demise, certain legacy is left out to the family members. So that is where the power of attorney, all will writing, and the financial security plan comes into. All this are very, very important. Again, here also, if you see, first thing we have to plan is the bottom of the pyramid is plan for the unexpected things which are not in our control. We should plan well, properly. So next is, we are talking about, next slide shows which stage are we in. So nowadays, that spending habits are changed so drastically. It was a time when my father used to go to bank once in a month, withdraw his salary, get his salary, and then that money used to be there for entire month. So whatever the other additional expenses, anything unexpected expenses comes also, we are prepared that we will not go to the bank again, and we will be adjusting in the same money which we had. Now today the spending habits are changed. People today, we have ATMs, we have debit cards, we have credit cards to make more spending at our comfort. So thereby today, if you can see the youngsters investments or their bank accounts, by maximum 6th or 7th, you can see their accounts will be zero balances. So the one difference, major difference in attitude of investment change came is, earlier it was first save, then spend. And today the public or the generation is having a philosophy of spend first and save next. That is where the entire debt trap and the financial planning doesn't make any sense to these people, and they are getting to a debt trap and a financial insecurities. So it is very important that investments are important at any age of our earnings. So it's not that a 22-year person who started earning, they don't require any savings. No, they also require savings and they also require investments. So here you can see a person who is in 20.
Sir, excuse me, sir.
Yeah.
Sir, your presentation, your slide is not clear, sir. Partially only visible.
Is it now okay, sir?
No, sir. Partially only visible.
Sir, I have clearly kept the entire this one. Is it okay?
Oh, okay, sir. Okay, sir.
Okay,
Okay,
you
sir,
can
thank
tell me
you.
which size is okay. This size is okay?
Now, like, just close to the slightly
Okay, is
zoom.
it okay?
Okay,
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 Jana.
okay, sir.
Okay, so is it okay?
Oh, okay, sir.
Okay, so you can
Okay,
see a 20-year person, who started their earnings and first time, jobbers, and they have started their earnings where they don't have any dependence, because parents also will be in earning age and generally they don't depend on the kids. So the earnings, whatever they earn, there is nothing they have to pay or they have to have any commitments. So this is the age where people should really look to save and create a base for their future financial goals. So it's time is not a concern here for these people. They have started just their career. So they can have all the investments for long term. When I say long term, it can be 5 years above. We can treat this as a long term in financial products generally, and people can take a higher equity exposure in this age because equities generally give a good performance or good returns over a period of 5 years and above generally. So in that scenario, in since the youngsters who doesn't have any commitment or doesn't have any financial commitment specifically, so they can invest for a long-term horizon and preferably into equity exposed investments majorly. That can be direct investments into equity, or if they have a product knowledge and investment knowledge. Otherwise, they can also invest through a mutual fund route also. So this will be a very important thing. And generally, the thumb rule nowadays, there is a equity, how much to be invested and how much into debt. There is a thumb rule always. Our 100 minus our age is the thing which we can invest into equities, and the remaining amount you can invest into a safe investments into debt, that is debt related investments. Say for example, if somebody is 30-year age, so 100 minus 30, that is 70. They can invest 70% of their investment into equity related investments where they can get a better returns. And the remaining 30% they can invest into a short term or fixed deposit investments where they have a safety and guarantee of their investments. So at 20, this is what we can look into. And 30s generally you can see where we have dependent enter into as a wife, you get married and you will have spouse, so your expenses start increasing at that time. So you can be in a position to take a medium risk where, because you also require money at your disposal whenever there is any kind of spending is there, you require money. So you can choose the investments into a medium risk investments. And then you can see need liquid fund for emergencies. This is very important. This emergency fund related, we will talk in the next slides as and when it comes. So we require liquidity at this age, at the ages of 30 to 40, we will be, requiring liquidity also, because the spendings will be increasing, like getting married, going for a vacation, or, then a children's birth, and their, a basic start of the expenses will be continuing. We should plan for both the savings as well as liquidity related investment also. So we should invest into medium risk investments. So next you can see the age bracket of 40 age. So wherein people have increased dependence because kids are also growing, and they are into their education next levels, and the parents are also getting older. Obviously we have to take care of they might be retired, so that we have to take care of their health related, or their dependency also will be more on us. So our commitments will be on peak at the age of 40s, 40 to 50s. So here the expenses will be high, and the savings will be very low because of all the commitments. So here the appetite of taking risk is very less, because people will not look to invest into any kind of a investment which is there for 5 years, 10 years, because the expenses are there today. So at this age, you can see advanced planning and prior investment needs. So here we should see that whatever the investments which we have earlier done, that should be coming to us in help to take care of our financial needs at this age. So it is very important that the early we start, the better the savings would be, and we should not stop in between. That is a thumb rule. Stay, start investment early, stay longer, and continue the investment regularly. These three are the mantra which make us to be a successful investor, and get a good returns in our investments. Next, you can see the age limit of age. Once we get into 50, it is a time where we will not be keen to invest more into, or investing anything into for a life changing or risk taking capacities. it is the age where whatever the investments we are done, we should know that, okay, I will get 100 rupees or 200 rupees or, whatever the amount. That should be clear to us at this age. So this is the age where the risk taking capacity will be less. So the you can see it is an age where we will be starting, withdrawing or taking the amount, where we will be like, creating a corpus for our, immediate, pension or, annuity related. So this age, the risk taking capacity will be less. Emergency fund is also required because generally age of 50 and above is where, we get ailments and, hospitalization or, any kind of emergency treatments. All this will happen. So we should always carry a emergency fund at this age. Next is low risk appetite, obviously, because uh, we are going to retire in 5 years, another 10 years, or another 6 4 years. It is a time where we should require certain amount which is guaranteedly coming to us, so that we can live with that for rest of our life. So this is the age where we cannot take any risk. So it is very important that people will look for fixed deposit kind of investments or liquid fund investments or MIPs, which will give a regular income and stability of income also. At the same time, the risk is very minimal. So next last important thing is monthly income from our retirement kitty. So as and when once we reach our retirement, whatever the corpus which we have saved for last 20 years, 30 years, that we expect that amount should give us a regular income which will take care of our retirement needs. So this is how the financial planning happens at different ages of the persons. So it is very important that early we start, better the financial health of the family would be over a period of 30 or over the period of 40 or over a period of 50 age. So it is very important that youngsters should not think that this is just now I have started my earnings, let me enjoy. Because the savings are very, very crucial, and very important thing in this present scenario of market is uncertainty of jobs. So earlier it was a time when people once they get into a government job, they know that next 20 years, 30 years, 40 years, the job is guaranteed. But today's life, the life expectancy or the career expectancy in any profession is reducing, and people have to be prepared for that also equally. So it is very important. The same thing, we'll also discuss about the earning capacities and life expectancy in retirement planning while the slide comes. So next, we are going to the next slide. How should we plan? What should be considered while doing a good investment? While doing a investment, what should be considered? The very first and the most important factor which we should consider while doing an investment is inflation, because it's just like a time bomb. We generally don't estimate the importance of this. But ideally, whenever we invest, we should always consider inflation also while doing the investment. For example, inflation is how it works. You can see here. Are you prepared for this? This is one example about inflation. In 2000, you can see a loaf of bread was 10 rupees. The same thing, in 2010 costing to 16 rupees, and then in 2020 it was 26 rupees costing. And in 2030, at a rate of 7% inflation, it will be costing around 42 rupees. The best known thing we all can see is rice. In 2000, probably it would have been cost 1 kg of rice around 8 rupees. Now today you can see a good quality of rice will be costing nothing less than 48 to 50, 55 rupees per kg. So it is the product. This is because the cost of living is increasing and rupee value is decreasing because of the inflation. It is very important that whatever the financial planning we are doing, it should be considered whether the returns are better than inflation or not. And the inflation figures are like this. You can see in the next slide, inflation, the impact of inflation here. You can see 1 crore of investment today will be valuing after 25 years. If you see, it is valuing just 18.5 lakhs equal. So you that too at a very conservative inflation figures which we have taken, that is 7%. Otherwise, yes,
Sir,
ma'am.
yes. I am not able to see your presentation. We can see you only.
Ma'am, I have shared the slide. One second.
Now
Yes,
on,
slide. Now on.
now we can see you only, not the presentation.
I have shared the presentation, ma'am. It is going on. 1 second.
How to check whether your PPT is in on mode or off mode? Just check.
Is it available now?
Yes,
Can you
sir.
see
Yes, sir.
me?
Yes, sir. Yes, sir. Okay, sir. No problem.
Sorry, ma'am.
Okay.
Anytime anything you are not able to see, please let me know. Okay.
Okay. No problem. Thank you, sir.
So I think the before slide. If you have not understood, I'm just showing this. This is how the cost of living is increasing. Okay, as I said, 1 liter of milk in 2000 was costing 25 rupees, and 2020 it is around 65 rupees. So the cost of living and the rupee value is getting depreciated. So same product which was costing 100 rupees today may cost 150 rupees or 200 rupees down the line of 10 years down the line. So while we do a investment, a right investment definition is that any investment which can give a better returns than the inflation is known as a right investment. So that is a general thumb rule which as an investor we should always look into whether. And I'm not saying that for example most of our customers, you can see they'll be invested comfortable in investing into fixed deposits. Now, in this scenario, we should understand if a fixed deposit is giving a 5.5% or a 6% in current market scenario, and the inflation is at, say, for example, 7.5 percentage. That means we are getting a 6% as a returns, and whereas we are spending, instead of 1 rupee, we are spending 1 rupee 7 paise, outgoing. So we should always consider our investments which are giving better returns, whether they are giving a better returns than inflation or not. There are few index which have been given here, like consumer inflation. If you see, it is giving it it is at a 6.5%. Education inflation, education cost. It is basically education inflation is nothing but education cost, which is increasing by 10% on an average every year. And the most risky and the most difficult part is medical inflation, which is increasing at a rate of 15% year on year, which is a very sensitive topic which we have to be planned in our financial planning. So this is about investment, about inflation. So any investment which is giving a better returns than the inflation, we can treat that as a good investment, and we can go ahead of that investment. So different financial goals, you can see this. What are the different financial goals we all have as a earning member? To have a bigger home or a good home, to buy a car, to take care of our children education in a proper and well manner, and then take care of our kids' marriage expenses, then take care of our family vacation, and then have a happy retired family, correct? So it is very important that we should have a clear differentiation between the needs and wants. Before I go to the next slide, it is very important that people today are missing the financial health because of the debt trap. That is DEBT. I'm talking about debt trap, because people are more focusing on the lavish things and the wants and the desires. The needs, I hope all of you know that all of we are clear about the difference between the need and the desire. So need is something which has to be compulsorily fulfilled, and there is no alternative for that, like roti kapda makan we say, that is food, clothing and shelter. These are a mandate for any person, correct? Now there are certain things which are desires, like I would like to have a Benz car, I would like to construct a house in a Besant Nagar, or I would like to make my children to study in best university in world. So these are all a desire. Now today you can just see, buying a car is a desire. When I say today I'm planning after 5 years down the line, say for example, I want to buy a Benz car, which may cost around say 40 lakhs. Now in 5 years I have started.
Go ahead.
Yeah, ma'am. Ma'am, can you hear? Hello?
Yes, sir.
Yes, sir, we can hear you. Yes,
Okay, somebody
Carry
was
on.
saying something.
no
Okay.
problem. Carry on.
Oh, okay, ma'am. So what I'm saying is, there should be, desires can be modified, desires can be altered. Say, for example, today I'm planning to have a Benz car, down the line now for 3 years or 5 years. Now, if my investment doesn't make, to buy a Benz car, I may buy a, Hyundai car or a Alto car. Absolutely. With that, my standard of living or, my comfort of living may not get, any kind of a hampered. But at the same time, at the most, what happens if I don't have a car? I go by a two-wheeler. I go by public transport. With that, nothing is going to change in my life. But the same way, if it's for need, there is no other go. If we have to have no children education, that if today a kid is born, we know that at the age of their 18 or 20, they have to go for a higher education, and the expenses are today itself fixed to all of us. So if we don't prepare for that, then definitely at the age of 20 or they're 18, we have to run for here and there, selling our hardened assets, or selling our investments in between, or taking a debt from the bank or any lender. So it is very important. Needs cannot be postponed. Needs cannot be altered. Need cannot be modified. If I have to retire at the age of 60 or 65, I will grow old, and I will some or the other day I become 60. And when I become 60, I have to no retire. If I am not retired, also the companies, the organizations will make me to retire. And at that time, if I say that I don't have a savings and I want to work for another 10 years or 15 years or 20 years more, even though I'm willing, I may be healthy, but most of the corporates or the organizations, they may not allow me. So it is very important that the needs to be planned first. Then we should plan for our dreams and desires. So with that note, we'll be going to understand the couple of products which very important. One, the protection need, as I said, we should all have a complete proper life insurance, which is very important. When I say this, a general note, general assumption, people will say, sir, I have insurance, or I have already done investment. I am paying some amount in LIC. See, nowadays, it is mistaken that insurance is treated as investment, which is not exactly. Insurance has a different purpose. It is used for loss of income, income replacement tool only. It should be used as an income replacement tool. So to understand this, the next slide shows what is human life value, which is very important. That okay, now Mr. Kameshwara, you told me that I should have a insurance. Well and good, but how much insurance should I have? Somebody says I have a 10,000 rupees every year I am paying. Somebody says I am paying 1 lakh per year. Is it enough? So this is very important to assess that what is human life value. That means as a earning member of my family, what is my value, which cannot be replaced, or which can be replaced if tomorrow, as if I am earning a 50,000 rupees as a income, for example. So my family is dependent on this income only. So my family is consists, what are the regular expenses I will have? That is, maybe I may have a car loan, or I have a home loan. I may have children education, or I may have some other commitments. All these expenses are taken care with my 50,000 salary only. So what is my human life value? So that I should know that well, because if tomorrow as a earning member, if I'm not there, my family should get this 50,000 month on month, so that they can lead the same financial life comfortably over a period of time, as long as they are alive, and they can meet their financial goals and their life goals in absence of me also. So that is what. So that. Some noise is there? Yeah. So you can see here a pictorial representation is given that your family is like tree. So as long as you are there, you are nourishing and you are giving a water, manure, everything, and your family is growing, your family tree is growing. Now just imagine if the earning person is not alive, what will happen to the family? That is where the protection need comes into the picture, and that is where the insurance plays a crucial role in this scenario. So same thing here, you can see if 50,000 is my monthly expenses, that is per day. Let us take 2,500 rupees is my 2,000 rupees is my per day expenses. So if I'm not there for one day, no, the per day expense is 2,000. If I'm not there for 1 week, it will be 2 into 7 days, 14,000 rupees. If I'm not there for 1 month, it is 50,000 rupees. Now, what if I'm not there forever? So this is the first important factor which we should all understand this, and we should plan for this first question before we start any investment in our life. All the goals will be active and live and will be fruitful when the income is given for those many years, that is for 10 years or 20 years or 30 years. So it is very important that we should calculate our human life value, and we should have sufficient insurance for us, which is very important. The simple thumb rule, or one of the thumb rule for how much I should have a life insurance is your salary, monthly salary into 200 times should be your minimum coverage you should have. One small example, if I am getting a 50,000 rupees salary, okay, why 200 times? Maybe somebody from the group may ask, why 200, why 100, why not 100, why not 150, or why not 300, why not 350? Here the logic applies as like this. Say for example, why I'm saying 200 is, if say for example my salary is 50,000 rupees, so into 200 times means how much? 1 crore. So I should have, as a person who is earning 50,000 rupees per month, I should have a life coverage of minimum 1 crore. Why? It's simple, because assuming that I have a 1 crore insurance today, and down the line, okay, after say 6 months or 1 year or 1.5 years or 2 years down the line, okay, if I am not there, okay, then my family will get how much? Entire 1 crore will be paid by the insurance company to my dependent, that could be my spouse at that time. Say, assuming that my spouse is not a financial literate person, and she is not aware about the financial investments and other things, one regular or common investment which everybody knows is fixed deposits. Correct? So assuming that if she invests this entire 1 crore into bank fixed deposit, you can understand how much interest she will get on this 1 crore. Say assuming today the bank is giving 6.5% as a interest. So on 1 crore, you can see the interest of 6.5% will convert into 6.5 lakh as a amount. So the same thing, if you divide by 12 months, the amount will come around 55,000 rupees per month, approximately. That means I'm earning today 50,000 rupees, and tomorrow when I'm not there, my family is getting 55,000 rupees as a regular income. So a 5,000 rupees more, if they are getting, no problem. 1,000 rupees they are getting more, absolutely no problem. But the question here is that, is the interest rates are the interest rates are fixed? No. The answer is no, because the interest rates keep on varying based on the RBI rate cuts, rate increase, repo rates, and other things. The bank FD rates will be increasing and decreasing. So to what extent it can decrease, the simple thumb rule people follow is, whatever the saving account interest we are getting, above that another 50% we can expect as a return in fixed deposit. Example, in saving account, if bank is giving 4%, means if you keep your salary in your account and you are not taking anything from your money, that money will fetch a 4% returns on that. Example. Now, if somebody has to invest into bank fixed deposit, at least we should get a 50% more than a saving account interest. Then only people will be investing into fixed deposits. So that means 4 plus another 50% will be 2%. That means at least 6%. So that is the thumb rule that maximum the bank FD rates, how much it can go down would be up to 6%. The bank FD rates can go down. So in this scenario, let us assume I have 1 crore. Now the bank FD rates have come down to 6%. Now on 1 crore, 6% would be how much? 6 lakhs. Again, you can divide by 12 months. How much it would be? 50,000 rupees. Means even in a worst scenario, my family should get a 50,000 rupees, which was my present earning. That much money my family should get. So this is how you can also calculate your human life value, and all of you should have that much minimum coverage. So somebody has 1 crore into 200 times means they should have a 2 crores minimum life coverage. Okay, so this is a thumb rule. There are various, calculations and various, other assumptions and definitions are there for human life value. But to make it simple to calculate by every person, this is a simple thumb rule all of us can keep in our mind. That is, your monthly salary into 200 times is the coverage, is the sum assured you should be having a coverage. If it is not there, that means you are undervalued or you are undercovered. The most of us, before I go to the next slide, people usually say, sir, I am paying in Jeevan Shree or some other Indian policy 1 lakh.
Sir, please.
Yes, ma'am.
I can see you, sir, and not see your presentation. Somebody is interrupting, sir.
Okay, I'm just again, ma'am.
Yes.
Yes, thank you, sir.
Can you see that?
No, sir.
1 second, ma'am.
Yes, sir.
Yeah. Is it visible, ma'am?
Yes, sir. Yes, sir.
Okay, so this is what is every person should have enough coverage. As I was saying, one example. If somebody is having somebody says, sir, I have a 1 lakh every year I am paying. You can see how much coverage you have in that one. 1 lakh if you are paying, assuming that your monthly income you should have at least 50,000 to at least 60, 70,000. Then only you will be able to have a commitment of 1 lakh every year. So assuming that your salary is 50,000 and you are having a 1 lakh every year you are paying. Okay. In this scenario, you can see you will get a 10 times of a life coverage in any return yielding investment. That means if you have 1 lakh investment, 10 times of that would be 10 lakhs. Means you have a coverage of 10 lakhs only. Whereas a 50,000 earning person, how much they should have? Ideally, they should have 1 crore. But in this scenario, the customer is saying that I have paying 1 lakh, but the person in fact is having a coverage of only a 10 lakh life coverage. That means in absence of the customer, the family will get only 10 lakhs. Now you can calculate at a rate of 6.5% on 10 lakhs, how much the family will get income. It is 65,000 rupees per year, and per month it is 5,000 rupees. So is it sufficient to live a life in absence of the financial earning person who is an income earning person? If they are not there and the family gets a 5,000 rupees, we can all question ourselves whether it is feasible or it is advisable that family can live with 5,000 rupees where the monthly expenses are 50,000 around. So it is very important. We should not see, when we talk about insurance, we should not see as how much premium you are paying. You should see how much insurance risk coverage is getting to you. So it is very important, this factor. If this is there, that means next 20 years, 30 years, if I am there, yes, I can make all my family dreams come true by earning, by being alive, by growing in my career, everything. But if any point of time in next 30 years of my earning phase, if I'm not there, my family will not be there on roads. they'll be at least financially strong, and they can make fulfill their dreams and goals achieved in absence of me as a earning person not there also. So this is the importance of financial human life value and life insurance. So you can see a simple illustration is given before we go to the left side of the slide. It is right side. You can see what are the regular household expenses we get: school fees, fuel expenses, electricity bill, house rent, water bill, phone bill. Now just imagine the day when we are not there, who will pay these bills? How the family will be surviving when there is no income? So this is a simple thought, but it is very important to plan for this. So you can see the benefits of term insurance. It's a lump sum amount is paid during the death. Why? What are the benefits of term insurance? You can see here. Okay, it shows that the first benefit is we get a lump sum benefit. That is when a person is no more, the company, the life insurance company can provide a lump sum amount to the family. That is 1 crore or sum assured or 50 lakh sum assured, what we have been planned, that will be given to the family so that they can live a peaceful financial life. Next is it provides a financial security for the family. As I said, if I am there, yes, I can take care of my family financially. If I'm not there, also my family is financially secured because of the risk coverage. Next is lump sum amount paid for accidental coverage. So if we are alive, if we are earning, the three things we should be prepared. One is death, the other one is a disability, the third one is disease. So if these three, if we are taken care, that means our earnings are guaranteed for next 20 years or 30 years. So these three threads we should plan. So here it is also planned that with a small nominal amount, you can also be covered for accidental coverage also. And then lump sum amount can be given during the disability of the person. That could be, that is, person is alive. If we are not alive, family will get a sum assured, that's well and good. But if we are alive, but we are not able to take care of our earnings, then in that scenario also we should be prepared. For that also the options are there in life coverage. So life insurance policy gives these options also. So wherein you can go for a critical illness benefit or a disability benefit, where any kind of ailment or a disease comes, that treatment also will be covered, and also your premiums, future premiums will be waived off. So that is in term insurance. Then supplementary income. So in case of any ailment, the company will pay certain amount as a income to the family member, the earning person also, so that they can continue their livelihood, even in case of any kind of disability. That could be, due to accident or due to, paralytic attack or any kind of a problem. The person, if they lose their income, earning capacity, then at that time also, the term insurance can help the customer to take care of their life financially. So next one is special it is C of loans and liabilities. So whatever the loans we have, all that can be repaid, and our family can be at least debt free at that time. As I said, if I have a 20 lakh, say 30 lakh or 40 lakh home loan, and if I am paying every month 30,000 rupees or 20,000 rupees EMI from my salary, so tomorrow if I'm not there as an earning person, that debt will be a liability to my family. So if there is a regular income, my family can pay those EMIs, and the property can be there, the shelter can be there to my family, even I'm not there also. So all the debts, maybe we have taken personal loan or car loan or home loan. So all these debts we can clear with that lump sum amount, and the family can live a debt-free life. So these are the few benefits with term insurance. Next important thing, which is very, very important thing which people should think of in this scenario. All of us know that coronavirus, how it is impacting and devastating the people's life. It is very important that if not corona, still health insurance is very important. My dear friends, those who are on call now may be saying that leave corona, but otherwise should we have insurance for health or not? Yes, it is very important. Why? Because You can see the need for health insurance here. It is a medical emergencies can affect anyone anytime. Lifestyle diseases and their costs are increasing exponentially. So lifestyle diseases means most of us are not having a proper diet, stressful life. Maybe we are not moving any kind of physical stress. I mean physical exercises are not happening. So because of all these habits, cancer is one thing which is spreading. Which is the most affected disease. Then heart attacks. Then in terms of other ailments, BP, sugar. These are the ailments. Lifestyle diseases are increasing. So these are also costing a lot on our pockets. So one time if any heart operation or any cancer treatment to be done today nowadays nothing less than 3 to 4 lakh the expenses are happening. So it is very important that to save the same 3 lakh or 5 lakh, it may take all of us whatever the salaries we are earning, it may take at least 2 to 3 years on an average. But if the medical expense comes, you can imagine within a day, within an hour, entire 5 lakh, entire 10 lakh, the amount goes off. And I'm sure when a ailment comes, we will, if we have to decide between life or death or the money, I'm sure all of us will choose health and life only. Correct? So in that scenario, what will happen is whatever the savings we have done for 3 years, 5 years, one we will have to withdraw that money and pay for our medical expenses, or else we don't have a savings. Then what we will be doing is taking a personal loan and do the payment and start paying the personal loan EMIs. There are people who are caught into this debt trap. And
Sir, your voice is not audible, sir. Somebody is presenting.
hello,
Sir, now it is audible, sir.
I think somebody has muted in between. Okay. So health insurance, as I said, no, it is a very important thing which will be important to not to affect our financial status and not affect our financial goals. Because if we have a 50,000 salary, I'm sure most of us will have commitments towards almost 90% or 80% of our salary definitely. Now, just imagine any expenses which come, 20-30% of expenses comes more. What we will be doing? We will be taking a pinch on our savings, which will affect our goals like children education, children marriage, or our retirement. These goals will be affected. So it is very important that we should have a health insurance. As I said, thumb rule, how much we should have. Like in health, we should have in life insurance, we said 200 times. In health, we should have at least 8 months to 1 year, monthly salary we should have as a sum assured for health insurance. That means if my salary is 50,000 rupees, 8 times would be at least 4 to 5 lakh. 4 to at least 6 lakh is the minimum I should have as a life coverage. Sorry, health insurance. So it is very important that this health insurance is very important nowadays, which will take care of if any kind of if we have a health insurance, what will be the advantage would be any kind of ailment if it is identified. Okay, so the treatment cost will be borne by the insurance company. So we will not get any, and if a 5 lakh cost or we are going for a policy of 5 lakh, so then the 5 lakh cost up to 5 lakh, if any health expenses comes, the company will take care of. So thereby our liability will be there to the extent of the premium which we have paid. say for example, a 30-year person, for him and his one child and spouse, they may, if they are looking for a 5 lakh coverage, they may be paying 11,000 to 12,000 rupees. Okay, so if our liability is up to 12,000 only in a year, that means 1,000 rupees per month. But if any time, if any medical ailment happens, we are safe up to the extent of 5 lakhs. Now, this is very important that, thinking of 1,000 expense per month, if we don't do that, we may incur an expense of 5 lakh or a 6 lakh, or at times it could be, certain diseases cost 15, 20 lakhs also. Now, in that scenario, you can understand 15 lakh or 10 lakh of debt, and paying a 10 to 12% of interest on that cost how much? If I take even a conservatively a 5 lakh health insurance, say for example, for my sufficing my medical insurance, I have taken a 5 lakh personal loan from bank. On a worst case, I may be ending up with a 10.5 or 11% as a interest. Now imagine, on 5 lakh, if a 10% also interest is paid, yearly 50,000 rupees we are going to pay as an interest only. And in 5 years, if you are going for a personal loan, you can imagine you will be paying for 5 lakh loan, you will pay all another 2.5 lakh to 3 lakh as an additional interest amount. Is it right? Because you are losing your 5 lakh investment money also to the bank. That is 5 lakh principal which you have taken. At the same time, you are also paying another 2.5, 3 lakh as a interest also. That means in next 5 years, your savings is getting pinched to the extent of almost 8 lakhs. Your savings is getting drained. Because of that, that may impact your retirement savings, that may impact your children education expenses, or it may impact your children marriage or buying a house, or any kind of other goals which we have, that will be hampered or that will be delayed. So it is very important that we should have a minimum health insurance of how much? At least 0.5 to 0.75 times of our annual income, or in terms of simple number, it is whatever the salary you are getting into 10 times you should have a health insurance. That is 5. If I'm getting a 50,000 rupees, I should have a 10 times would be 5 lakhs. So 5 lakhs I should have as a health insurance. Now you can see you will get a tax benefit for this also here under section 80D. So wherein as an individual you can invest up to 25,000 rupees and you can get the tax benefit for that. Also, you can invest another 25,000 rupees towards your parents if they are there less than 60. So if your parents are there and they are less than age 60, you can take another 25,000 rupees health insurance on your parents' name also, and you get a tax. You can claim a tax benefit on both the investments. That is health insurance for you and your family members, plus health insurance which you have taken for your parents who are less than 60 age. Another 25,000 you can invest, and you can get a tax benefit on both the investments. Same way, if your parents are above 50, above 60 age, then instead of 25,000 rupees, you can invest up to 35,000 rupees. You can do investment and you can get the benefit for that also. That is in your name and your family name 25,000 rupees, and your parents' name another 30,000 rupees you can invest. Overall 55,000 rupees you can invest, for which you get a tax benefit also, and you are financially secured to the extent of 8 lakhs or 10 lakhs for you and your parents also if any medical ailment comes. So this is another thing. When I say health insurance, most of the people will say, sir, we have a health insurance in office giving a medical insurance, so I don't require. I ideally suggest that every person should have their own individual health insurance policy for them and their family members, because organization jobs are not guaranteed. We may work for 10 years, 5 years, 20 years, and after that, once we retire, then if any ailment comes, then the organization will not come into picture. So it is very important that and if you want to take insurance at that age, health insurance, probably the companies may not allow. That is the biggest challenge. For example, I am today 30 and I am saying that my company is taking care of my health insurance. That's fine, but just imagine once I reach a 45, 50 and I'm not in that job, and if I have to undergo any medical treatment, I have to pay from my pocket because the organization doesn't care me when I'm not there associated with the organization. And at that time, if I want to take a health insurance also, the companies may not allow me to take insurance because at that time I may have a pre-existing disease, some pre-existing disease like diabetes, sugar, or a heart attack, or some other ailment. Then the companies may not cover that disease, and they may charge me a heavy premium also on that. So it is very important. One simple thumb rule for those people who say that organization in my organization I have health insurance. I suggest keep that insurance for your parents who are seniors and definitely who will be there in the age of 50, 55, 60, 70, 80 age. Keep that coverage for your parents, and you have a separate policy, private separate individual policy for you and your family members always. Why? The advantage is, one, in office, whatever the insurance you have, that will take care of it comes at a nominal premium. Number one, the premiums are low. Number two, it also covers the existing diseases which are already there. So generally, when we say parents are 60, 65, 70, definitely some kind of ailment will be there for them, and we cannot guarantee that when the treatment may need can occur. Correct? So in that scenario, it is always better in group insurance policies, group health insurance policies. What happens is your existing diseases will also be covered and the premiums will also be less. So I suggest keep your office insurance for your parents aside, and take insurance for yourself. Now with this, what happens is you are also financially covered because you will have insurance for you and your family members. And in individual policies, generally there will be a condition of pre-existing disease. Means you have to, if you have some disease and if you declare that, you have to wait for a 3 years or 4 years waiting period. After that only that particular disease will be covered for treatment. So in that scenario, what happens if we have individual policy, we are of a 25, 30, 35, 40 age, and we don't have anything now. So we can continue this policy for 4 years, 5 years, so that 5 years, 10 years, what happens is by the time any existing disease comes also, I will be overcome this 5-year period or 4-year waiting period, and I will be covered for any disease anytime if I get. And for me and my family, the premium will be less compared to if I have to take the same thing policy for my parents who are at 60, 65 age. So in terms of keeping premium as well as existing disease coverage, keep always your group insurance which is offered by your organization for your parents, and you and your family should take a separate health insurance policy, which is very important. And when I say insurance, health insurance, it can be you can take an individual policy on your name, or you want entire your family to be covered, you can cover
Sir,
your family
please.
members also. Yeah, ma'am.
Can we view, sir? We're not view your presentation.
1 second, ma'am.
Participants, mute your audio and video, please.
Can you see, ma'am?
Oh, yes, sir.
So
yes, sir.
yeah, so I'll go to the next thing. As I said, you can go for as an individual health insurance policy, or for your family members you can take. Next is another set of insurance which people health insurance which people can look is critical illness plans also, which I said which will cover the major diseases which are very critical and which will be costing more, like heart attack, cancer treatment, paralytic attack, neurosurgery, or any kind of organ transplantation. These are all certain diseases which will cost very high expenses. At the same time, we may not be able to immediately go back to our work once the operation is done. Correct. So these are all treated, which may require a 6 months bed rest, or 3 months bed rest, or a 1 year bed rest. And post operation also there may be certain expenses which may be recurring. For example, somebody is taking a treatment for cancer. After operation, they have to go for a chemotherapy, radiation therapy, which will be costing, and which will not be covered in other things. Whereas in this critical illness, those serious ailments will be covered, and it comes with a very, very nominal premium. For example, a 30-year person, if they are taking a critical illness plan, they may pay for a 10 lakhs sum assured, just a meager amount of 2,500 rupees in a year. So just by paying another 2,500 rupees or 3,000 rupees in a year, you will be covered for all the 35 diseases which will be mentioned by the company. All those diseases, any ailment comes, your medical treatment will be taken care, and you will get an entire amount, during the disease is identified. Next is super top-up plans, which I say that, somebody says, my organization is taking care of my health, I don't require. Those people, they can look for, going for a super top-up plan. What this means is, if any expenses, medical expenses comes to me, up to a certain expense, I can take care of. And above that, if any expenses beyond that, if it comes, I require insurance. I just give you an example that if somebody says, say for example, I say that, I can take care of, I have a savings of 2 lakhs or 3 lakhs, and up to 3 lakh, if any medical expenses comes, I can withdraw my fixed deposit or my savings, and I can pay my, medical expenses. But if any expense which comes more than 3 lakh, it could be 5 lakh, it could be 10 lakh or 20 lakh. So in that scenario, I will go for this super top up. So in that way, what happens is, I can go for a higher sum assured at a very nominal cost. For example, a super top-up plan, which I say a 30-year person, if they want to go for a 10 lakhs coverage, where they are saying, up to 3 lakh, if any expenses they come, they will take care of by themselves. And above 3 lakh, if any expense comes, up to 10 lakhs, I require a health insurance. So for that, it is a small premium. It will be costing around 800 to 1,200 rupees is the premium which person can pay, and they can go for this super top-up plan. That means suppose if I have a 3 lakh cash, and I am going for a medical treatment of say 7 lakhs, and I have a policy for a super top-up policy for 10 lakhs. So in this scenario, up to 3 lakh, whatever the expenses, say I have now getting expenses of 7 lakhs for my treatment. So in 7 lakhs, the company will pay only 7 lakh minus 3 lakh, which I have confirmed. That is 3 lakhs. I said, while taking policy, I said up to 3 lakh, if any amount, expenses comes, that I'll take care. So above 3 lakh, any expense comes, the company should take care. So in this scenario, since the total expenses are 7 lakh, and I have promised that I'll take care of 3 lakhs cost by myself, so that will be deducted, and 7 lakh minus 3 lakh, that is I have to pay, and 4 lakh will be borne by the company. So you can see in this, the premiums are very nominal, and in this super top-up policy, you can take a policy for you and your family members at a nominal cost of 2,000, 2,500. You can take a coverage of 5 lakh or a 10 lakh coverage also at a nominal cost. Next is personal accidental policy. This is also an important thing which we are should plan out for, because nowadays road accidents and other accidents are increasing, and which is again a big devastation in terms of financial health of the family members. So people can go for a personal accidental plan also at a very nominal cost. That is, for every 1,000 rupees, 70 paise is the coverage on an average. So if somebody want to go for for example, 1 lakh, they can pay 700 to 800, 70 rupees to 80 rupees per lakh. The charges will come around. So if somebody want to go for a 10 lakhs coverage, they can pay 700 or 800 rupees, and they can get a coverage of 10 lakhs. That is, if due to accident, if anything happens to the customer family will get a 10 lakhs sum assured given to the family of the customers. Then the next one is on illness specific plans, which is special plans like heart care plan, or cancer care plan, or BP or diabetic plan. Like this, most of the companies are now coming based on particular ailment coverage. So if somebody see that their family history has a diabetic chances, so they can go for a specific plan which will be covering the diabetic related treatment. So in this, the advantage would be, again, as I said, the premiums will be less, and the only condition here would be that coverage will be there for that particular ailment only. Suppose if I'm taking a cancer care policy, I'll be covered only for cancer related diseases only. The same way, if I take heart care plan, that will be covering my heart related any ailment comes, bypass surgery or any kind of angioblast or any other thing, that will be covered. So if somebody is looking where they have a family history of heart attack or other ailment, so in that scenario, people can go for a ailment specific risk coverage also. So these are the various health insurances which we have, which are there in the market. So you can choose any of this based on your requirement and conditions. Next is very important thing, retirement planning, which most of us are not realizing, and most of us nowadays we are, especially those who are in a typical age of 30 35, they are ignoring this, and they are completely planning the investments into which are not necessary at this point of time. The very important thing is, if we are born, if we are alive, definitely the age a day will come where we will retire and where we will become old. If any person is immune to this, or if they are against the nature, I don't say anything. I'll be happy for them. But if any person who says that yes, I will be in my life, a stage will come where I'll become old, then they should really plan seriously for their retirement, which is, as I said, these are the few pitfalls which people generally assume that that I can manage somehow. Means, okay, if it is retirement is there at after 20 years or 30 years, let me wait, let me first complete my immediate needs. I'll see as and when it comes. It's too early to plan. So like youngsters, as I said, we feel today only I have started, let me enjoy my life, let me plan it later on, and that later on will never come, because later on only the commitments and the expenses will increase only. So even your salary is increasing, the expenses also will proportionally increase. So the savings ratio will not increase any point of time in life. So please remember, there is nothing called too early or too late. Next is, I don't have enough money. Yes, we usually come with this reason, and some people say I don't have time to plan. This is again a biggest blunder people will do. And the other things, people with more responsibilities, they say I have other commitments too. And people say I don't need to save because I feel I will die by 30, or I will live by by 50 I will die. So some people predict their death also, surprisingly. So these are thing, and I don't want to be think about it. The best thing is ignore your problems. Okay, that is escaping from the reality and closing our eyes, thinking that it is dark. This is another set of people who generally ignore the retirement. Somebody will say, I will start at the age of 45. That is again best thing is to postpone your retirement. This is again a biggest challenge. And next one is, yes, it is important, but I don't know how to do. This is another set of people who comes into while planning the retirement. Now the next slide, it shows that why it is important to plan for retirement. This is a very important thing which all of us should be really cautious. Uh, Today, all of you might be knowing the term called demographic dividend. That is, generally any country will get this in 100 years one time. This opportunity. Demographic dividend means the people, the people with the earning age, or the people who are there in the earning age, or the people who are in young age, they are treated as a demographic dividend to the country. Means they, since they will be earning, people who are typically between 20 to 40, they are that is the age of earning time. So people who are in that age, they will earn, they will spend, they will be contributing to the economy growth and their financial growth also. So any country will get this demographic dividend once in at least 100 years. So you can see China, which is presently, you can see there people who are in a 60 to 60 and above age, people are there today who are in a maximum 70% of people, or at least 60% above people are there in retirement age, which is a threat to the company, I mean to the country. Now, the same way, whereas India today, it is enjoying the demographic dividend, because people we have people, almost 60-65% of population is typically is there in the age of 22, 35, 40 age, which is the earning age of the people. That means all these people will go for jobs. 60%, 65% of the population who are in a 22, 40 age means these people will be earning, they will be spending money, so that that will help the government or the organizations, industries to flourish. So at the same time they will also have their own savings, so that will also increase their income saving capacity. So these are all demographic dividend which India is enjoying presently. So obviously you can understand next 20 years India is going to grow because of this one advantage. Some noise is there. Can you mute? Yeah. So this demographic dividend, India is presently enjoying, and we will enjoy this for next 20 years at least. Means next 20 years, if everything goes fine, India can be a strongest economy, which will have a biggest consumption in world and biggest, growth in world. So this is a positive side. Now, if you see the negative side, you can see the life expectancy is increasing in India now. Earlier, in 1985, 86 time, no, you can see 86 to 90 time, the average life expectancy was around 60 to 65. Now it is increasing, on an average every 10 years it is increasing by 3 to 4 years. Every 10 years the life expectancy is increasing by 3 years on an average. So today, if you see, the people average life expectancy is around 77 age. Now, the interesting and fearful factor, if you see here, for male, the life expectancy is around 77 years. On an average, people are expected to live, the male, whereas the female are expected to live around 78 to 79 years, which is a very, very crucial thing that, which makes the husbands, the earning husbands who say that, I am there, as long as I'm there, I don't worry, I'll take care of. People who have this attitude, now you should really think of that, that a day will come when you are not there and the family requires, your spouse requires a income. They are alive. So this is very important that this demographic dividend is one thing. As I said, people life expectancy is increasing. At the same time, you can see the work life is shrinking. You can see the people who are age, the average expenses people, you can see the average life expectancy is increased by 77, 78 for female, 79 for female, whereas our job life, that is work life, is is restricted up to 45 to 50 only. If today any of us, if given an opportunity, when do you want to retire? I'm sure most of us will say, typically,
Sir, please.
hello.
Sir, make some adjustment in your presentation, sir. Partially we can leave.
Is it okay, ma'am, now?
No, sir.
Is it okay?
No, sir. Only 1/4 of the PPT only we can view.
I have reduced the size, ma'am. 1 second, I'll again.
Participants, kindly mute your audio and video.
Can you see me?
Yes, sir. No problem. Yes.
Okay. So, as I said, work life, if opportunity is given, I'm sure none of us will choose to work till 60. Correct. So, on an average, everybody would like to retire at 40, 45 age, or 50 age on a higher side. Because even though we want to work, at times, the organization may not give us the time to, stay in the jobs. So with that, what happens is the biggest threat is our earning phase of life is restricted from earlier parents. You can see they would be joining at 20, 22 the jobs, and they will be working till they're 60. That means average span of earning will be there around typically around 40 years, 35 to 40 years. So they used to have 35 to 40 years of earning phase. But today, the average earning phase, if you see, it will be hovering around 20 years of maximum if everything goes fine. So in that scenario, what happens if I am a 30-year person, I can work up to 50 years or maximum 55 years. But I am going to live up to 77 or 80 years without any income. Because once we retire at the age of 55, I'm sure there was no organization will give any income to us. Correct? So in that scenario, we will be left out for next 55 to 85 or 80 years without income. That is 25 to 30 years of our life will be being alive without any kind of income, which is the biggest threat to India. Which if we don't plan today, down the line of 20 25 years of the down the line, India will also face the same problem which today the China is facing. So in unfortunately, like US and other countries, we don't have any social security where the government will take care of our medical expenses and retirement expenses. Where we don't have such expenses, I mean such kind of plans in India. So it is we have to plan for our own retirement. So it is very important. This one factor we cannot ignore, that we are going to work for 20 25 years time only. At the same time, we have to take care of our life without any earnings for next 25 to 30 years while we'll be alive. So it is very important that this slide is an eye opener to most of us, that we will be alive, with a disease and treatments. So we may not have at the age of 60, we may not have any kind of a commitment, that is home loan or children education or children marriage, everything we might be complete. But the one expense which we are not calculating in our life is medical expenses. You can imagine, in previous slides, I have shown the medical expenses, at an inflation of 15%, it is increasing. Now, that today, if 5 lakh expense is there, you can imagine the same 5 lakh expense may not be same after 25 years of the time. It may be costing 20, 25 lakhs of the treatment. Now, just imagine if our savings are not there, what do we do, and how do we take care of our retirement life? One is medical expenses, which will increase today. On an average, in a year, a 30-year person may visit hardly one time the doctor. And they may spend, if a specialist we are meeting, a doctor will be spending 500 rupees as a consultation fees. Now, just imagine at the age of our 55 or 60, maybe every month we have to go, or every week we have to go. Let's assume positively that every month we have to visit the doctor. So the 500 rupees expense today, after 25 years, nothing less than it would be around 5,000 to at least 7,000 rupees one visit. Now you can imagine if you have to visit the doctor for 12 times in a month, it would be at least 60,000 to 80,000 rupees. Our visiting and consultation charges would only be costing, which is a real threat. And it's not to make any person to fear for this, but it is a fact. If we don't plan ourselves, whatever the good earnings we are earning, tomorrow all these earnings will lost in to cover our medical expenses. So it is very important that planning for retirement is very important. So one small example here given in this slide. Say today the current monthly expenses, if we feel 50,000 is enough, okay, you may not the same 50,000 expenses at the age, that is the age today is 35. Now you can see, suppose you are going to retire at a 60 age, that means you have another 15 years of life, sorry, 25 years of time. So today, whatever the 50,000 per month your expenses are there, this will be increasing to 2,14,000 rupees per month. And this is at a very conservative 7 to 8%. I am taking this as a inflation. My dear friends, if you can see it can, in reality it can be more than this also. That means whatever the expenses today per month I require 50,000, maybe after 60, at the age of my 60, I require, for the same set of expenses, I require 2,14,500 rupees per month. So please don't ignore retirement planning. General thumb rule for retirement planning is, at least those who are not planning, those who are not willing, deliberately at least you should invest 10% of your saving, your earnings into retirement related investments. That means if you are having a 50,000 rupees as a salary, you should invest at least 5,000 rupees. You should keep it aside for your retirement without any kind of thought. So this is one example. So to get 2,14,000 rupees per month, the retirement corpus you should have is, it is mentioned as 3 crores 21 lakh. You should have a retirement corpus. So this is for those people who are at 35. So people who say that I'm a youngster, I don't know, I have to enjoy or I have to take care of my present present commitments. You should think that your retirement is there after 25 years. The longer the retirement time is, the higher the savings you have to do ideally. So it is very, very important to start early and to keep. For example, the same thing, if you can see 50,000 for a person of 50 years, they may require per month around 80,000 to 1 lakh. So that is because in next 10 years they are going to retire, and the cost of living, which is today 50,000, may cost around 1 lakh down the line for 10 years. So they may require less savings, because that is for the lesser span. But whereas those who have a longer time, the real risk is there to the youngsters who will be growing old after 25 years or 30 years period of time. So it is very important that youngsters have to plan for the retirement. Next is few of the solutions which can help us to achieve our retirement solution, our national pension scheme, which is a central government has introduced this plan. It is regulated by PFRDA, that is Pension Fund Regulatory Development Authority of India. So it is an initiative which government planned to take care of the retirement solution of the Indian citizens. So all the salaried people, they can, or individuals who are into business, they can invest into national pension scheme. What are the benefits here? You can see the features of the national pension scheme in one slide. It shows Indian citizens who are between the age of 80 to 60, they can invest into this. The lock-in period here, it is there till you are 60. That means you cannot withdraw any amount in between. Why? Because the objective is to save investment for your retirement, not for children education, not for buying a car, or not for repaying your home loan. So it is very important that people should come with a mind that I should be staying in this for 60 years. Next is partial withdrawal is there because more people are demanding, more people are asking. They have come with a condition that 25% of your amount you can withdraw. That is after 3 years of account opening and continuous investments. Then it can invest into, unlike PPF, it will be investing into, PPF invests typically into government securities, that is into debt investments. Whereas national pension system is giving an opportunity to invest into equity. It is also giving an opportunity to invest into government securities and corporate fixed deposits and alternative investments also. So wherein you can get a better returns than the inflation, and you can create a good corpus for your retirement. Next is investment choice. As it is said, those who are well versed about equity, debt, and other investments, they can decide where to invest their 100 rupees or whatever the amount you are investing. Where to invest, you can decide by yourself. If you are not aware about the asset classes, you can leave the choice to the fund manager itself. So you have a choice of active choice and auto choice. Next is the cost, which is very important. So there is a fund manager here who will be managing your cost. So there will be certain charges will be taken by the fund manager, the company. So in this, if you see, these are the lowest cost charges. The charges in this are lowest.
Sir,
That means
please.
if you're invest, yeah, ma'am.
Sir, we have 10 more minutes only. We have also the interactive session. So,
Yeah, I'll finish off with this, ma'am.
okay.
Okay. So it's a low cost investment, and it is fund management charges are very, very less, and it gives you a tax benefit apart from section 80C and 80D. This gives you additional tax benefit also. So people who are say that no, I have invested into insurance or no ATC investments, ATD investments, and I want to invest more for tax saving. They can invest into national pension scheme also, wherein the average returns are 5-year returns. If you see, it is coming around 10 to 10.5% returns, which is far better than PPF returns. So PPF are now at how much? 7.9. It is last one, and it is reduced furthermore now. So when it is compared to that, 10.5% is a fantastic returns people can look into, wherein in a 10 12 years, in 10 to 20 years of your life, this 2 to 3% of additional returns can fetch you another few more lakhs more corpus into your retirement kitty. So this is mutual fund also people can invest. It is example, you can see here retirement, a person who is at 25 age, if they invest 5,000 rupees per month for next 30 years, they will be investing 18 lakh entire period. And you can see the investment is growing up to 2.81 crores. The same thing if somebody is delaying by 5 years, and if they are investing at a 30 age. Ma'am, some noise is there, can you mute please? Yeah. So the next example, if somebody is delaying by 15, 5 years more, that is, if they are starting their investment at 30 years, you can see their investment for next 25 years will be 15 lakhs, and they may get a corpus of 1.37 crores only. So it is very important that start early and stay invested for long term. That will create a good corpus for your retirement. Okay, so this is through mutual funds. Also, you can invest children education. As I said, we should again, children education is also influenced by inflation, which is increasing on an average 10 to 12% every year. The same engineering which we were doing, I remember my MBA in 2001 was costing 25,000 rupees for 2 years. The same thing, I'm sure all of us know what is the MBA or engineering cost today to complete. So it is very important that I since time is very short, I'm just running in single slide this one. So consider the rising cost and changing needs of your children education. Look for the premium and look for the options. Mutual funds is another option where you can plan for your children education. You can also plan through ULIPs. You can also plan through insurance related investment. You can plan for your children education. Also, you should see are there any partial withdrawal options are available while investing for your children. At the same time, you can see that you should read the conditions and withdrawal and other investment conditions carefully before you plan for your children education. So next is three mistakes in your life to say no. That if you don't have a no term plan, that is a big mistake. No health insurance is a mistake, and no SIP. These three are the big mistakes. If people doesn't take care of, these are going to be the costliest financial mistakes which we'll be doing in our life. And investment solutions next comes. So these are the few assets which have given returns in the last 25 years. The average returns we have given as a pictorial reference. So that Sensex, that is market, is given 9.3%. Gold has given in last 25 years average returns of 8.93. Bank FDs have given 8.71%, and equity related mutual funds have given a average of 12 to 12.18% returns. So based on your time horizon and returns expected, you can invest into any of these. Even gold is treated as a asset hedging tool for our investments. So ideally, we can look for 10% of our investments to invest into gold also. So this is one more important thing which we can always plan. And today people have various options that to buy a gold, you need not to have to buy a physical gold only. They are available in ETF format also. That is exchange traded funds, wherein you can buy in any denomination. You can buy for 500 rupees. You can buy for 1 gram. You can buy for 1,000 rupees, either in terms of amount or in terms of grams. You can choose, and you can buy at your comfortability. If you have to buy a physical gold, nobody will allow you to buy for 500 rupees. At the same time, when we are buying a physical gold, it will have making charges, wastage, other charges which are not considered while we sell that. So to avoid those kind of things and to have as a pure investment, you can also invest into gold ETFs also, which can be ideally out of your savings. You can invest 10% into gold in related investments also. And you can see the next slide, which is on different asset classes. Based on your risk appetite, debt investments are the most safe and secured investments. So if somebody is looking for a guaranteed or regular income or which is measurable, they can invest into debt-related investments. Those who are looking for little moderate risk and want to invest, real estate is always another investment option, which over a period of long term, which will always give a better returns. Next is equities, which is having a higher risk. So people who want to take a higher risk and expect a higher returns, they can invest into equity related investments. And then the commodities. These are the various asset classes which are available to invest. So the color indicates the risk which is involved into that. So based on this, you can plan your investments, where to invest, and how much to invest. And the next is, a very important thing. We should all know the investment starts with the magic word is called power of compounding. Eighth wonder also, it is also known as eighth wonder. So here it is given. Systematic investment plan is an option wherein you can invest a small amount every month, irrespective of the markets. You can start investing a small amount and you can create a wealth for yourself and you can achieve your financial goals. So this is a SIP. This is about systematic investment plan. You can see the power of compounding at 8%, at a 12%, at a 15%. How the amount will grow in 10 years, 15 years, 20 years. So somebody is investing at 10,000 rupees. In 10 years, they'll be investing 12 lakhs. At a rate of 15%, you can see the amount will grow to 27.5 lakhs. Now, the same thing, if you invest for 20 years, your investment will be 24 lakhs. Even at a 12% returns, you can see, you are going to earn 1 crore rupee for yourself. So, and also, as I said, inflation related information is also given here. You can just go through this. And the features of SIP are choose any date. The way we should invest through a systematic investment plan is because you have a flexibility to choose any date you can start invest. You can choose any amount you want to invest. You can stop in between any time. You can increase your SIP amount or you can decrease your SIP amount. Also, you can redeem whenever you want money. You can redeem. There is no locking kind of a thing. Whenever you want, you can withdraw on that day. Whatever the investment value is there, you can withdraw that. And you can, last one is, you can stop your SIP and let your investment grow also. That means you have all the flexibility, in terms of investments. And next slide is on, small illustrations are given on SIPs, different SIPs and, different tenures, how much they can fetch us based on the investment goal. Suppose somebody would like to invest, get 1 crore. How much they can invest for 20 years, how much they can invest for 15 years, 25 years, 30 years, the investment, how much they can invest, that is given so that people can plan the investments monthly to achieve their financial goals. And this is a self-explanatory financial mistakes checklist. All of you can just go through this, and you can do your own financial health checkup, whether you are done enough of financial planning, whether your investments are in a right direction, or you are doing any mistake. You can assess yourself with this simple questionnaire. I suggest all of you to take this and assess yourself where you are exactly fitting into. Ma'am, can we stop, or can another 2 minutes can I take, because I have another 2 slides to go.
Yes, sir.
So the next one is how much we should save. Simple few thumb rules we have shared. I'm sharing here that out of your 100 rupees of earnings, you should plan 30% on an average to your regular needs. That is food, your medical expenses, transportation, housing, and other things. And then for the next another 30%, you should plan for your home loan, education loan, or any other a car loan, whichever you have commitments. For that you can plan, and remaining 40% you should definitely invest into for your savings and investments. So savings is The definition of saving is that it is there whenever you require money, you can easily withdraw and you can take that money for your usage. Whereas investment will give you returns, and it may require certain time to grow and certain time to hold for. You cannot withdraw in between. So what are the different savings you can do is emergency fund, EPF, PPF, NPS, mutual funds, stocks, and NPS. These are few investments. So out of your 100 rupees, 40 rupees, ideally you should always save. And next one, you can see that how much EMIs we should have. This is again one more important point. So ideally, out of your salary, okay, 100 rupees of your salary, no, you should not have not more than 40% should not exceed your home loan. Your EMI of home loan should not exceed 40% of your salary. Car loan, if you are going to, you should not cross, at least it should not cross beyond 15%. Personal loans is the most riskiest investment and costliest mistake. You should not have more than 10% of your overall loans. So, and in overall, you should not cost, you should not cross your 50% of earnings. It should be, it should not cross beyond 50% your debt. So EMI should not cross beyond 50%. This is a health financial arogya mantra. So please always remember this. How to get wealthy? It's simple. Start early, spend less from your earnings, and save more, and invest in the right products for right time. So if you are investing in equities, you cannot expect good returns in 1 year or 1.5 year or 6 months. So same way, if you are investing in debt, even in 10 years, 20 years, the returns cannot be greater. So you should choose right product. Also is also important. So those who want to make your financial life healthy, you should start early. There is no future postponement. Second is you should spend less and save more. Third is invest in right products which can fetch you good returns and make you to support you to create your wealth. So the last slide, as I said, comes to the end. There is no time is perfect for investments. It's always investment timing is important. So whenever you are deciding that day is the right time, don't postpone your investments, and don't make your life difficult in financial planning. So plan well and create your financial planning. So we are also providing a financial planning link to all our participants, which will be shared by the management. So whoever is interested to get their financial planning, yeah, Ganashakti.
Yeah, so, that PPT not visible.
Oh, 1 second. Is it visible?
No, the WhatsApp it's showing.
1 second. I'm last slide only. Anyways, I'm just finishing that. So as I said, this is the last slide which I have shown how to get wealthy, and this comes to end of the slides, and we are giving a just I have shared the financial planning tool link to Ganashakti Well, who will share with you all. So whoever would like to get the information that in fact how much I should have a life coverage, or how much I should have health insurance, how do I plan for my children education, and how much I should have for retirement, and how much I should do investment per month. All that investment advisory will be provided at free of cost, and that service will be provided by Mr. Ganashakti Well, who will share the link to all of you. Once you share, update the details and share that details, Ganashakti Well, and his team will get in touch with you, and they will do a complete financial planning free of cost to all of you, which is you can decide down the line which are your goals, which are important and which are immediate, and how to invest and how to take it forward. So thank you all. Now we can, ma'am, we can go for a Q&A session.
Yes, sir.
So
Yes, sir.
can I off the screen?
Yes, sir.
So, participants, I hope no, since because of the early delay, we have lost a good time and now try to complete the entire presentation in 1 hour time. Hope the slides are informative and a basic glimpse about investments will be are all of you would have got. So, any questions we can have?
Sir, very good afternoon, sir. Am I audible?
Yes, sir.
Myself, Dr. Thiru Aruran.
Yes, sir.
It was at the outset, I really appreciate your presentation with full of information, personal finance planning.
Yes, sir.
My question is,
Yes, sir.
as we invest in systematic investment plan,
Yes, sir.
which has been for past 4 years,
Yes, sir.
but due to this COVID impact, there has been a decline of nearly 12%.
Absolutely, sir.
So my doubt is, as an investor, I'm a bit concerned about depreciation of. It might be a time being, but it is a depreciation of investment. Could you put a light on how far it will take to regain the momentum? Will it ever get into positive note of plus 13% or plus 12% from negative to positive? Please, sir. Thank you.
Yes, thank you, sir. Thank you for asking general doubt, which is now running in every investor's mind. Thank you again, sir. Rightly said. The present scenario, definitely those who have invested last 4 years or 5 years around, they may be seeing a fall of 12% to 15% on an average negative returns. But as I say, this is a temporary or a temporary, medium to temporary situation wherein this is a time where we should invest because the units are getting available at a 15 to 20% reduced price. And the investment which we have started is not with a horizon of 3 years, 4 years. It could be for the long term horizon, correct? So in that scenario, I suggest to please continue that, because in this scenario you are getting the units at a cheaper price, which is around 12 to 15% less cost you are getting. And even though the this particular phase of COVID, which may take for another on an average, if it let's positively take it, if it minimizes by another 6 months to 1 year also, this is an opportunity where you are going to buy the asset at a cheaper cost. So I suggest to continue this. And there is no doubt why we should not continue, because this COVID is a temporary phase. But whereas the Indian population, which you can see the strength of country, are there in an earning age where people will definitely will keep continue their jobs, even though the job loss which we are seeing. I'm sure some or the other solution people will find, and people will start working, and this is going to be a temporary phase. So again, the economy will be back as a big, every person who is going to earn will also spend. That will automatically, indirectly, directly impacts the economy also, and things will again be back on track. So I suggest to invest into large and mid cap related investments at this point of time. And if you are having a 10 years kind of a horizon, still you can invest into a bit of your investment. You can invest into mid cap or small cap funds also. Please to continue your investment is what my suggestion is.
Right, sir. Thank you. Thank you.
Thank you, sir. Any other questions, participants? Participants, any other questions? Sir, your voice is not audible.
Audible? Hello?
Yeah.
Hello,
Okay,
sir. Am I audible, sir? Hello?
Yeah, it is better.
1 minute, sir. Sir, am I audible, sir, now?
Yes, sir. Mr. Jafar, I can hear your voice.
Hello?
Yes, sir, I can hear.
Hello, sir?
Sir, I can hear your
Yes,
voice.
sir. Sir, actually, which is the appropriate scheme wherein we can deposit? Yes, sir. Which one is the appropriate scheme where we can deposit our money and we can expect a high rate of return in the near future, sir? Can you please suggest the best method of depositing the funds, sir? Can you please suggest
Sir,
one of the
nearest
things, sir?
future, sir, for me in no financial terms, if you ask me, short term is anything less than 3 years is a short term. Anything which is 3 to 6 years, I feel it is a medium term, and 6 years and above will be a long term. So you are looking for a short term kind of investment, means what is your duration you are looking for?
Sir, let's say 3 years or 4 years,
So
sir.
3 to 4
4 years
years,
would be better, sir.
definitely,
4
sir,
years.
you can invest into large cap investments along with little stake in arbitrage funds, which our colleagues and tomorrow and after tomorrow when we have a sessions, there will be a detailed presentation on mutual funds and equities. So they will further detail. But at this point of time, what I suggest is people
Okay,
who
sir.
are looking for a 3 years kind of a 3 to 4 years of a horizon. You can look for 60% around into a large cap segment, and another 20-25% into arbitrage funds, and another 10% you can look into investing into gold investment also as a hedging tool.
Fine, sir. Sir, and
Yes,
one more
sir.
question, sir, if you don't mind. Sir, for marriage purpose, a kid is there, sir. Around 8 years, 9 years kid is there. For marriage purpose, I wanted to invest some money in the appropriate scheme, sir. So which one would you suggest, sir? This is the final question, sir.
Definitely,
Thank you,
sir.
sir.
As I said, kid age, if it's around 8 is what, if I'm not wrong, you said 8 years around, correct? Present age. So another
Yes, sir. Correct, sir.
15,
Correct,
20
sir.
years is a decent period. Definitely you can look into equity related investments wherein it has a combination of large and mid cap combination. You can look if you are an aggressive customer who can take some risk. Otherwise, there are children specific investments are there, like HDFC Children Growth Fund. ICICI has similar children growth investment plans, wherein it will be investing around 60% to 70% into equity related, and another 20 to 30% investment into debts. Debt means fixed deposit kind of investment. And you can see the HDFC
Okay,
Children
okay, sir,
Growth
okay.
Fund, on an average, it has given 15% compounded returns in last 18 years, which is a fantastic returns. Probably,
Okay.
in where it has a debt combination. In debt combination, if a fund is giving a 15%, which is a fantastic returns, even if it gives you a 10 to 12%, I am sure in this market, it is a great returns. So if you are looking in that way, you can, if it's a lump sum, I suggest, this kind of investment. And if you're looking for a regular investment, that is every year certain amount you want to invest, then I suggest you can look
Yes, sir.
a combination of ULIP combination also you can look into, wherein you will have a coverage also of life, so that in the next 20 years down the line, whether we are there or not, the marriage expense of 20 lakh or 30 lakh, which you are planning, that is available to your kid. At the same time, if we are alive also, that 30 lakhs, we are generating the revenues.
Fine, sir.
So if it's a
Thank you,
regular
sir. Thank you,
investment
sir.
you are planning, you can have mutual fund and ULIP combination. If you are planning for a lump sum investment, then you can look for investing into any mutual funds in the combination which I have mentioned.
Okay, sir.
Sir,
Thank you, sir.
how
Thank
to
you so much.
evaluate
Thank you,
and
sir.
identify the best mutual
Hello.
evaluate and identify the best mutual fund?
Sir, best mutual fund, how to evaluate or how to identify? Always, we go by face value, goodwill in India. So some noise is there. Would you mind? Can somebody who is unmuted? Can you mute? Yeah. So, good fund, certain thumb rules or no standard thumb rules which we can look into is one is the fund manager. Generally, those who are there for number of years and based on the portfolio asset, how much they are managing based on that asset size. And then third thing is based on their past performances. Fourth is based on the beta and alpha which they are giving, the risk, how much the fluctuations are there in the fund. Okay, based on the beta and the alphas, that is the returns, you can decide which fund is giving a better returns, which is less volatile when compared to the markets. And the fund manager who is there for long term, and a fund manager who is managing a good AUM. These are few thumb rules people take into consideration while deciding which is a good fund. But this is not going to be a strict guideline, because there are fund managers who are managing even a 300 crores and who are there for last 8 years, 10 years, like Mirai funds and all. They have a less fund management, less AUM, but they are also managing well. So at times, you can look based on the capabilities and the performances managed by the fund manager also.
Sir, a simple concept of analyzing the fund and selecting a fund, kindly explain, sir. For as an ordinary customer.
For ordinary customer, sir, first is you have to see based on your risk. Okay, suppose you are a risk taking customer. Risk means if you are investing 100 rupees, if it goes to 90 rupees down the line, you are able to manage that risk. That is called the risk of investment. Okay. So how much risk you can take, you can decide based on that. Okay. And the tenure, if you are there for long term, that is 5 years or 10 years or 3 years kind of a horizon, based on your term, the investment will vary. It's not that one factor which will be suitable to you and to some other person also, because every person has their own risk taking capacity and their own time horizon. So based on the time horizon and the risk taking capacity and the returns expected, these three things makes the difference.
Sir, another one question. Per Sensex point increases, how much amount is invested in the market, sir? Per unit of Sensex point increases.
You are asking how much you can invest.
Sir, if BSE Sensex.
So that is you want to invest or?
No, sir. Entire capital market I am speaking. If BSE Sensex 1.